Welcome to the podcast. Joining me right now is Paul Hill, full-time investor, equity analyst. All right, fella, I've got a question for you, actually, straight away off the bat.
Go on, then go for it. I'll let you start.
This is on video, by the way, if you want to see our faces. I'm dressed a bit army fatigues kind of thing, because I just think it's appropriate.
You're being battered.
Yeah, well, it is like a war zone. But yesterday, and in fact, we just had news out now, of the Bank of England raising interest rates 0.75%, the highest since whatever, I don't know. But and also the Fed, Jerome Powell, the head of the Fed, they came out. And I was watching CNBC and I caught the tail end of it. And they said he's a lot more hawkish than we thought, and he's looking at a lot more rate rises, down the line there. But yet the market's rallied, and none of the talking heads there on CNBC can understand that. They're saying, why are we rallying? He sounds like he's a lot more aggressive on this rate rise than we thought. So can you beat them, Bull? Can you top those guys, the talking heads, and explain why the market's rallied?
Well, I'll give you my educated view anyway. Basically the market had already baked in about sort of 6 Fed hikes anyway, and to go to 6.5 to 7, etc., is a bit tighter than what they expected. But frankly, the bigger picture, the big show in town, was that the market is encouraged about developments between Russia and Ukraine in terms of ceasefire talks, that may mean that we have an ending to that conflict, which would be great. And also big picture is that the oil price has started to fall, which is obviously a huge lever when it comes to sort of global inflation. And if that starts dropping, and one of the reasons, I don't know if you saw last night, I mean, we are, just to let you know, all investors who are listening to this, we are recording this a day early this time. So this is on Thursday lunchtime rather than actually it'll go out on Friday. But with the oil price, I don't know if you noticed yesterday, I'm sure it wasn't coincidence that's the lady, the British citizen who was released from Tehran. I'm convinced they've had some behind the scenes negotiations between Washington and Iran, such that if Washington withdrew their sanctions to allow Iran to pump another 4 million or to allow their 4 million barrels of oil per day to go onto the market, then Iran, all it needs to do is to let a few hostages out and to do some soothing noises in terms of the nuclear. So I think those are the two big things, i.e., such that we've had improvement in Ukraine. Well, not improvement, but the market are thinking that there's going to be a ceasefire in the imminent future, and the oil price has come down, which means inflation expectations at least have sort of quietened off a bit. So I think the market's getting a. You've got to remember the market is sort of looks a lot faster and makes views about the future than the Fed, who just obviously a bit pedestrian, and that's why I think the market rallied hard yesterday.
Yeah, and I suppose so the Fed were behind the curve there, and the uncertainty of what they're going to do. And in fact, like I said, they almost signposted they were behind the curve yesterday. When they decided to go really hawkish. When for a while they've been holding back a bit, but I'm assuming they won't just go headlong into it and just keep rising rates. They'll also check the economy, check what's going on with employment and all that stuff. Because and if inflation is tapering off, then they won't just keep rising, will they? So there's some room for a bit of flexibility there, isn't there? So
yeah. I mean, I think the language they normally use when they're basically just going to push the button on it is they go autopilot, and they've taken that language out over the last year or so, because they've had their wrist slapped in the past for using the term autopilot. And so you're right, it's going to be data dependent, but I mean, the good news is that the consumers still want to spend, i.e., particularly in the States. The holiday bookings overseas are pretty high. The housing markets is still strong. Likewise, the auto market is still strong. And if we do see an alleviation of some of the supply chain problems that everybody's anticipating, and the oil price does drop from over $100 per barrel, then you can actually see some pretty positive economic data coming down the track. Admittedly, obviously, I think the sanctions for Russia are going to be in place for quite some time. But if you do have other oil and gas sources, and China can manage to sort of sort out its COVID problems, then exactly. Well, I mean, that's the other big curveball, isn't it, in terms of supply chain? Then
it's odd that, isn't it? Because there's demand problems as well. They're saying because China's going into lockdown in certain areas, you know, someone has a sniffle, they lock down the entire city.
Yeah.
So that reduces demand, but also it affects supply, doesn't it? You know.
Oh, it's hugely. I mean, obviously they're the manufacturing breadbasket of the world, aren't they, by a mile, particularly on assembly of parts and systems and electronics and this sort of stuff. So, yeah, I mean, that's going to be, that might put it quite difficult to get a sort of a fridge freezer or something like that, or telly from China. But yeah, I mean, that's how the market's actually looking at it. And it took it as a positive that, you know, the global economy isn't going to fall off a cliff over the next 2 years. Whether that happens is difficult to know. The one downside is that the yield curve, the bond vigilantes are actually saying that, you know, because it's flattened, particularly between the 5 and the 10 year, and it's nearly totally flat between the 2 and the 10 out in the States, then it doesn't take much to tip it out into a sort of like an inversion and, you know, predicting a recession. It's going to be a more challenged environment in Europe and the UK, no doubt about it. So when it comes to sort of equity selection, you want sort of like good exposure to the States. Some, you know, if they invoice in dollars, then that's great. And more importantly, you want secular growth trends that are going to happen anyway. Companies, we talked about good pricing power and, you know, high levels of IPR, and we'll come on to it later, but I've been buying, I've had a few shopping lists of those type of stocks recently.
Yeah, I was going to say, have you invested in a company that is in the States or the invoice?
Yeah. Well, they all have big exposure, but let's not sort of go there at the moment because I'll come on. I mean, you know, we'll do that in a moment. I mean, another company who came out with sort of like with regards to its test and validation study was Lunglife AI this morning, and it said that because it started its validation study, I think it was in February, with first patients being, or first samples being taken from patients. And this one, Vector, is just to recall, Lunglife does, it does a test for early stage lung cancer. The idea is it's going to complete this validation study in about exactly 12 months, actually, Q1, I think, in 2023. And it said on its validation study that it was actually including the Veterans Association out in the States, which is important because it's got the biggest requirement in the States for lung cancer testing. So it's going to be included within it, and also named a really good guy to head up their to help their scientific committee. So again, another one which is sort of like, come out of sort of excellent research and being developed. But this is another best in class test. It uses CTCs as a blood draw to be able to diagnose whether somebody's going to get early stage lung cancer, which is different currently on the market. They use other things like immune response, which for cancer is not as good. Whereas for what Verici did, when they used effectively an mRNA, well, not an mRNA. It's I think it is actually. It's basically a signature profiling of a person's immune response, and that works well with effectively donor organs because you're looking at immune response. Whereas for cancer, it's quite difficult to use your immune system to accurately predict whether somebody's going to get cancer later on, where it's better to use CTCs, which are circulating cancer tumor cells, which are actually, a very much better predictor of somebody, whether they're going to suffer from cancer. So, yeah, I mean, they're on the same track, probably 12 months behind in terms of, getting first sales, but doing exactly the same thing, and huge addressable market. In fact, bigger than, the Verici's is the sort of $700 million dollar market at least, and this one is about $2.9 billion per year market. So huge addressable markets, assuming their best in class tests actually work, get validated and put out in the field, which frankly the world desperately needs to be able to it's the world's biggest cancer killer, lung cancer. And likewise with as we know from kidney, transplants, people desperately need to get off dialysis machines to be able to have a much better quality of life.
Look at that, an estimated 900,000 US veterans are at risk of lung cancer, and VA hospitals diagnose around 7,700 new cancer cases each year. Huge, isn't it? Killer.
Oh yeah, no, and it's massive, yeah. And currently the patient's outlook is very poor as well, because once you get it, then it goes to advanced, and then you die. It's just a matter of when it happens. So yeah, I mean, it's you need getting early treatment is essential to be able to stem the effectively pandemic in lung cancer across the world. Yeah. Anyway,
did you been chatting to anything else?
Yeah, what did you see? Did you see the news for Avingtrans this morning? They came out with after their interims a couple of months back. They said they actually won two big. They won 3 contracts today, multi-million-pound. Again, I mean, Avingtrans is a niche engineer in. It does sort of like parts and aftermarket services in highly challenged or challenging conditions, and one of its businesses, Boohoo Industries, sold some blast-proof safety doors into the nuclear industry, and then the other 2 divisions it bought over the last few years, again, are sort of like now profitable and growing well, and they're supplying parts into actually, incredibly, they're trying to. There's a project down in the south of France which is actually trying to replicate how the sun generates its power using magnetic fusion, and they're providing equipment into there, which is another fabulous endorsement, saying that it gives a good tick in the box to their technical prowess and just quality of their whole service offering. So to get into that type of project just says everything about the quality of the actual business and underpinning full year numbers. But they still,
it's one of those businesses, like I say, if you companies looking for that kind of stuff, there's not many places you can go to, is there?
Yeah, absolutely. It's pretty much unique. Yeah, I mean, I when I do the sum of the parts valuation, I get around about £5.40 compared to, I think it's about £4.10, £4.20 today. And Singers are on about 5.10. You can easily see that, and you can see upside. And their biggest shareholder again is Christopher Mills, because he can see the value upside. But the management doing a great job. The shares have, they've done 20% per annum annualized, gains over the last 10 years. So the direction of travel is up on that one. Looks a really good stock. Looks a really good company.
Yeah. And no, it is. I mean, talk to them. It's one. It's almost one of the things. You've got to deep research these companies as well, because they're in niche areas, and all of that, Lunglife and Avicii and Avingtrans there, and you realise why they're in a real specialist field. And this is the kind of thing that, like I said, I suppose Buffett to a certain extent was saying, had to moat these kind of companies. You can't just jump into that space,
Yeah.
And so there's not a lot of competition there. Yeah.
Well, how's your bit? You had some news, didn't you? You had news on GFIN. Is it no? It was basically Trufin and Gfinity. Some was good.
On the same day, I had good news from Trufin and bad news from Gfinity. Well, do you know what? It wasn't bad news per se, but of course there was an announcement in there. I didn't describe it to someone like it's been given like an ice cream by one person and then get kneed in the knackers by another person. Because in this market, Trufin went up by 10% and Gfinity dropped by 50%. Oh my God. So Trufin, as you know, they've been doing a trial with Lloyds Bank for their Citago, the company they own there. It's invoice financing, a 2-year-long, sort of close to 2-year-long sort of trial. They've got sort of rubber stamp from Lloyds and their letter of intent to go forward. Lloyds have also taken a stake in them, a £5 million stake, which is quite rare for a company like Lloyds.
I agree.
Cap. I know. So that's very interesting. And and the expansion is massive. I mean, Lloyds is the biggest retailing bank in the UK. I think it's got 13 million customers. I think it's something like 10,000 SMEs. So huge opportunity for Stargo. And James, I was speaking to the CEO, supposed to do a podcast very soon, but he's almost now. They've mentioned they're talking to other people as well. Big companies or quite well-known companies, and he's convinced that could be Citago in time could be a unicorn. It's like it's ticking all the right boxes. People are loving it. And like I said, he was up against 11 other companies when they pitched for Lloyds, And Lloyd has said it's head and shoulders above anything else they've looked at. So it's very encouraging that. And then on the same day, Gfinity come out with a trading update for their first half of the year, which it's different sectors of the Gfinity. The one there, John Clark came in, a couple of years back, 2 years back now, and decided the esports servicing model isn't very good. The old management were burning cash on that. It was chunky revenue, very thin margins. He said, right, what we're going to do is start creating a digital media business, owning sort of niche websites around gaming, esports, hobbyist sort of sites around that area. And we're going to start getting those together, sort of acquire some, build some, and the synergies of this, you create excellent advertising campaigns. You can really get the average rate per user up. And they've increased the average rate per user from 4 pence per month to 23 pence. And they've gone from almost 1 million users, active users a month, to 16 million now. In February was their record. So Gfinity Digital Media, even though it's growing quickly, it's still not the major part of the business. The major part of the business is still the old chunky low margin part. That's dragging. And they want to get that out of that as soon as possible, because they are with big brands on that. They do the esports with Premier League, with Formula One, all that. But it's not very scalable. And they've also got a tech platform as well that pulls all the competition together. So those are two bits, the media and the tech bit are what they're expanding on. But it's very early sort of days. But even the digital media business did 1.6 million in revenue in the first 6 months of this year. It did that in 12 months last year. The growth through all the metrics are fantastic, but it was being dragged back by the old esports service business. And they're going to miss on revenue and miss on guidance, largely because of that business. And because of that, they had to say, oh, we may not have enough cash for 12 months. We may not do a fundraise. And so in this market, you don't want to do that. You don't want to surprise people with a fundraise. It dropped off a cliff, Well,
they've done the placing now. Yeah,
it's done the placing. They didn't need to raise that much. They said we only need to raise. We could have probably scraped by with the money we're on, but if we have any more delays, we probably would struggle. And so they had to put out that announcement. And so it dropped off a cliff. They only wanted to raise sort of just 1 million, they said. They've done 2.7 with warrants as well, which annoyed people.
Did you participate at all?
Yeah, I did. It's the first time I've taken part in the placing for like 5 years, and normally I buy the market and keep it in my ISA pretty much. But I took part because this is where the valuation is where I bought in at 2 years ago, and I thought this is a lot better business now. This is when John Clark came in. They're going to be profitable in 2023. The growth is fantastic in the core area of the business. They everything they own there is what they're developing. So yeah, it's a big knock, and a lot of people are annoyed by it. But the metrics,
you get that. Let's be clear about it. It happens all the time. It's part and parcel of investing.
Exactly. I mean, it's hard to transition a business, from one major part of the core business to another part of the business. It's working though, but it's still early stages, but it'll be profitable next year. So the costs have come down massively. Like when they first started Gfinity, the old management were burning like 5-6 million a year. Every year they're doing big placings, and people lost faith in it completely, and rightly so. But now it's gone down to like from even every half year. Have a look at the costs. It's got operating costs now gone down from 1 million pretty much last year, 900,000 to 400,000 for this half. And like I said, they'll be profitable next year. So John has consistently cut the costs every year, and the revenue is growing in that fast-growing part of the business. But as yet, it's still young and new, and that old part of the business needs to unwind a bit, But even valued on GDM, the digital media business, now you're talking about a market cap of like 14 million. They've got 3 million in cash. They're going to be profitable in 2023. It's very fast growing, so I'm happy to hold. I like John a lot. John Clark, he's a nice guy. In fact, I did a podcast today, Thursday. It's gone out, and he reiterates profitability of 2023. But yeah, it's never smooth, Micro cap, small cap, it's never going to be smooth, especially with changing the business model, So yeah, it's rough with the smooth, isn't it?
Well, yeah, and also, it's sort of like looking at your portfolio in aggregate as well, sort of like which of all the moving parts. I mean, that's been one of the drivers for me in terms of, I mentioned on the shopping list, and I was looking in tech and healthcare, etc. And I bought the last time we were on the pod, I mentioned I bought FD Technologies. Well, the last 2 weeks I've been looking at sort of big tech and software in particular, because it's got good pricing power, excellent sort of secular growth, and just really sort of like moving up the quality curve, because most of my portfolio now is just small caps. So I wanted some large caps with real sort of like, ballast and solidity. And it was really sort of like, because of the sell-off due to Russia and the Ukraine, and also, fears over the Fed tightening, you've had some sort of big caps absolutely, fall off quite really top quality companies. So I bought three actually in that sort of the biggest is SAP, which is a enterprise resource planning company, the world's biggest by a mile. Market cap is about 125 billion euros, so it's not small. Headquartered out of Germany, and it trades for about 13 times EBITDA. And it's got good growth, very good recurring revenue streams, excellent pricing power, and it's in about everything in enterprise, sort of like large corporates, etc. So I just thought, well, okay, that's a great opportunity. So I bought.
Where's it listed there? Is it listed in the US?
No, it's listed. It's listed in Germany.
Oh, okay, wow.
So I went out into the DAX on that one, and then I bought another German one as well, Infineon Technologies, which is the world's leader in semiconductors and chips for things like EVs and automotive and industrial electronics, Internet of Things, etc. Really, again, a high quality stock. Market cap is roughly around about 35-40 billion euros, so huge, growing at sort of like good teens, double digit. And as you know, there's so much a shortage of chips and across the world, that the pricing is really good. Margins are going up, obviously, but they're in some really hot areas, of Internet of Things, electric, basically all things electrification, digitization, but electric vehicles in particular. So they've got a really long, they should grow, double digits regardless of what the economic climate is going to be. And frankly, the automotive sector is still pretty depressed for new vehicles because it hasn't been able to sort out its supply chain problems. So they were really well placed. And again, they'd come down from about, sort of like 40 odd, 50 odd, euros to around about 30s. I think they were at where I bought them. So, I'm actually delighted. And the last one is again, another world leader, pure in software, which is listed in the UK. It's called Aveva. Not the insurance guys, but they do basically all things digital twin for manufacturing, sort of like large plants and stuff like that. So, you've got things like mining and commodity, renewables, manufacturing, chemical, all this kind of stuff. Then they are really one of the only games in town to be able to do that. They're not cheap. They're on about sort of 18 times EBITDA, but frankly, for this kind of quality business, is just brilliant. And I know their largest shareholder, Schneider Electric, who own 59%, have been buying up at these levels as well. So it just says everything that it's a great business. And it was really a bit of portfolio construction and making sure that it gave me ballast. And I took the opportunity to move up the quality curve and buy a big cap going at good, it isn't rock bottom prices. None of them are dirt cheap, but they're all sort of like very good, in my view, good growth at a reasonable price. You're paying decent, reasonable prices for premium assets, and which should grow really high single digits, double digits for the next sort of like 10 years. And there's because of the IPR and pricing power, it's a lot of that is going to fall through to the, more than that is going to fall through to the bottom line through, high unit dynamics, sort of gross margins and improving EBITDA margins. So when you've got that type of quality on sale, I just thought, right, okay, that fits what I'm looking for on a portfolio construction, because I had quite a bit of cash, and I had about 31% of my portfolio was in cash, and it's down to about 10 or 11% now because of those three.
How many stocks do you hold now then?
Probably about, I don't know, 12, 13, 14. I'd have to have a look.
Okay. Do you know what? Looking at FDP chart, I quite like that because it's. I don't know if you.
FD Technologies.
Yeah.
No, it's a great company. I'll tell you.
Because you know what? Yeah, it hit a bottom like that on the 24th of Feb, right? And for some reason, I think you mentioned it before. It had a big shoot up on the 1st of March.
That was Microsoft. You got that partnership.
That's right. And they're 20
with
quid.
Azure.
Yeah, and it came back down from 20 quid. So it went from 13, 40 quid up to 20 quid. Then it came back down to like 14, 15 quid. But that's what's called a higher low. It's bounced off that again now. So it looks like there could be a turn here in the chart. It's been sort of,
I think it's a top quality company. I think it's a top quality company. When I do the sum of the parts, I don't get anything less than £24 per share, and that's conservative compared to, I think one of their house brokers, Investec, are on about 41. And because it's got fantastic assets there, software and services, with being able to do big data and AI and handle huge amounts of real-time streaming in the financial community, and they're using that same technology elsewhere in other verticals. So I mean, I'm delighted. To be perfectly honest, I've redeployed quite a lot of cash in what I think are top quality tech companies, which are leaders in their specific field. So very happy. They're liquid, very happy to hold them, for a long period.
Yeah, like the chart there, it's a big bounce, but it's been quite a little bit volatile. We'll see. But
another good chart is, I don't know if you've seen, is Northbridge. They came out with a trading update. They basically said that they were changing the company's name to Crestchik. That's going to go to the general, and they said their trading had been in line with expectations, and they reinstated the dividend, because they've got plenty of cash now, because they exited the Australasian Tasman business, and they're just going to be pure plays on load banks. And where the market, in my view, hasn't yet understood the proper sort of earnings and cash generation power, is that the sort of two analysts there who write on it have just overlaid sector valuations for equipment rental onto Crestchik, onto Northbridge, which is just frankly wrong, because a load bank, which is their sort of bread and butter rental asset, doesn't degrade at all. There's no moving parts in that. It can last for decades, and all you need to do is do software upgrades and just keep it in decent condition. So your effectively replacement capex for that equipment is almost negligible, because you just expense it every single year. And that's different. That's hugely different to a normal rental model, which might be selling, I don't know, tools or, plant hire, which effectively are out into quite challenging environments and have to be written off every 3 to 5 years. So, I get a minimum valuation for the business of £2.40, and I think that's quite modest as well. Whereas the analysts are on about 190. So I think Crestchik, I mean, it's a good chart. It didn't come down at all, basically, during this, this whole volatility. And it's obviously, it isn't one of those mega tech stocks with huge liquidity. It just says everything, that actually it's very solid at current levels of about 170, and this could move higher very, very quickly, because once you start seeing this earnings power, and they bring the capacity on mid-year, another 50% to make load banks, this could fly from 2023, 2024 onwards, once our analysts realise that dynamic of all they need is growth capital. They don't need replacement, capex capital, and frankly, it means it's going to be self-funding going forward for all its organic growth, which could be really good. So I would point it to that one.
Yeah. I don't know if we mentioned this, but just another bit of stock news on that I had. I mean, did I mention that Getech signed an agreement with the Highlands Council to develop hydrogen hubs in the Highlands of Scotland? But it's very interesting, because I don't know if you know the traction here now. There's a couple of big news that's come out about hydrogen, of course, and we talked about this last time, I think, the reliance on Russian oil and gas. Because of that now, and it's a chokehold, a stranglehold on many countries. They're looking to now, decouple away from that and develop their own sustainable energy sources. And the EU Commission mentioned further boosts in renewables. They're going to quadruple the current 2030 targets for green hydrogen supplies as part of a hastily assembled sort of strategy cut from reliance on Russian gas. But and also there's another big one about national grid as well. By 2030, they're going to be pumping in more hydrogen into the networks, and say pretty much the network it will need some upgrades, but they can start putting hydrogen in, and of course, the UK having one of the biggest wind farms, the biggest wind farm in the world, but we're very suited to that kind of technology, you know. But yeah, it's a good deal with and slowly they're rolling out these agreements, and so they've done an MOU with the Highland Council Incorporated to develop a green hydrogen hub infrastructure. So there's 3 now sort of hubs they've started with. And I think it'll take a while to come, you know, to get it online. But it's good they're building, and I can see the momentum. And like I said, I look at I monitor news on green hydrogen every day, and the momentum is building massively. You know, all the big companies, especially the BPs and the Shells, they're all pouring money into it. And they can do with the profits they're making from oil and gas now, and with a deadline ahead of them for reducing of, you know, for decarbonisation. It's the momentum is building, not only for that, but for other, so EVs as well. But everything to spin out from, you know, get away from oil and gas, which is nuts. I mean, like I said, that Iran deal that's going to happen, you know, it's all linked up together. So we've gone from one sort of despotic leader to another regime there. And so the faster we can get off and have our own independence on energy, the better. And I think this now will accelerate the adoption of renewables, you know, in their own countries. So, yeah, I mean, it's not, the shape was annoying in this market. I remember the day a company announced good news and the share price would rise. You know, I remember those days. You know, these days goes up maybe a percent, then comes down the next day. It encourages sellers to come in and sell some stock, which is so annoying. But those days will return. Like I said, we're in a bear market. You know, what comes next after a bear market? Pretty much.
Yeah, no, it's hard sledging. There's no doubt about it. I mean, another company that put out some good news and the shares didn't move was SourceBio. It bought LD Path about 2 weeks ago for £18.5 million. Really on a it's a digital leader in all things pathology testing, which is used for sort of cancer screening, etc. And of course, we all know with aging demographics, the huge patient waiting lists, you know, to the backlog, etc. And the benefits of doing all things telemedicine, getting away from sort of like you know, overburdening the NHS is just driving growth, and this whole sector's going at about, you know, good double-digit per annum sort of growth. Anyway, LD Path is right in there, and they added it. They bought it, and they've you know, it'll be earnings accretive and value accretive as well. And I think their broker has Liberum said that the actual, when you put in the synergies, it's on about sort of 8 times EBITDA multiple, which is really good. You know, even though it might sound a lot in terms of 18.5, you know, sort of £1 million. And they have a, you know, price target of roughly around about £2.20, which you can easily see. So they've redeployed a lot of the funds that they've generated from their PCR testing over the last 18 months into, you know, acquiring businesses or good complementary and synergistic acquisitions into their base business, and they're growing that. So it looks a very smart deal to me. And of course,
look at that, they had cash at the 31st of December, 33.3 million. The previous year was 8.4. Did they do a fundraise, or is it just
no, that's just straight through from cash. Yeah, they just generated largely.
Generation, isn't it? Wow.
Oh no, it's been huge. Yeah, absolutely. Largely on the back of their PCR testing, but even after the 18.5 million, you know, has been paid, then they're still going to have sort of post-completion around over 15 million of cash, which is roughly 21p per share. So they've got, you know, future scope to do more M&A and give them, you know, ammunition elsewhere. So there's plenty of things they can do. But yeah, that's still cheap at the moment, and it's because of it's obviously, you know, the market isn't great, and anything with good news doesn't seem to be sort of sticking, does it?
Well, no, you know, you look at these. You've got these German companies, for example. You say they're world leaders, they're pretty well known. But
yeah, Infineon and SAP.
Yeah. So how do you how did you come about those, and how did you go about researching those? Did you have some kind of filters there? Well, I mean, how did they come on your radar, for example?
I just knew about it. I've been watching them for years. Yeah,
okay,
absolutely. Yeah. I mean, you know, it's good value, and the sectors are good, and you know, it's a kind of thing whereby you don't. Anything where you've got a sector leader that potentially falls off on the back of really not it's just the market sentiment. Something to get it. And I'm looking for that. I'm looking for mega big cap with huge addressable markets, strong barriers to entry, good secular growth, pricing power, IPR, the whole works, fantastic endorsement. You get it with those stocks, so they fit the bill to a certain extent. I can't complain. I'm delighted.
No, exactly. It's funny that there are very few companies at the moment. I'm obviously all in small micro caps, But the only one that's held up pretty much is Trufin. I mean, it hasn't dipped at all. It hasn't moved downwards, and so it's odd, isn't it? Looking at Northbridge there again, that's had a strong performance. But there's very few. I've looked at many charts. I look at lots of charts, and most of them, like I say, bottom right.
Yeah. We'll have a look at another one. Another one which I'll keep banging the table on. Equals. I mean, look at that chart. It came off, and now is going back up. And basically the problem in Ukraine and Russia, if anything, is going to be a positive catalyst for the business, because it's put the cat amongst the pigeons in terms of the forex market. And so its bread and butter corporate customers will be hedging more to try and protect themselves going forward. And I'm sure it's done well. I mean, we'll find out, because I think it's having their prelim results at the end of the month. But and I'm hoping to touch base with the guys. But another one which should be doing well, and I'm sure it probably is. We'll wait and see anyway.
It's one of the things, isn't it? People they start panicking about the war and stuff, and everyone starts selling everything, and then people calm down a bit and think, "Oh, hang on a bit, that's not going to be affected by the war. In fact, it's probably going to be
beneficial."
Yeah.
They just use it as an ATM. People have made a bit of profits, need to cover some short positions elsewhere, and they, sell it off, or the market sells it off for whatever reason. Another one whereby the shares have just been decimated, which seems to have hit a floor, hopefully anyway, on AIM, is Boohoo. They came out with a, I own that one. It hasn't been my best investment. I'm 2/3 down. I've only owned it for less than a year, and it was a really big company. But it came out with an inline trading update last week, and said that its sales in the fourth quarter grew like for like 7%, which is a pretty good effort, because it was against tough comparisons from last year. And it looks as though, hopefully, fingers crossed, now we've reached a bottom on performance in terms of.
When did you buy? What price did you get? When did you buy
about £2.60. I mean, it's at about 90p. I mean, it just is one of those. It's one of those things, isn't it?
It is, and every now and again you have one of these, general, really deep sell-offs. Generally, because the market, a couple of stocks will hold up, but generally the whole market sells down. And if only we could have patience to sit on our hands, and have a big chunk of cash, and wait until. Because I think we're going to have a Pfizer day. I really do. I think sooner or later, whether someone just shoots Putin or something happens, or they just have peace talks. And I think the market will have a big up day, and then it may stabilize like that Pfizer day back in November.
I would agree. Yeah, it makes sense.
But then you will think, I wish I had a lot of cash now. It's the money's been sucked out. All can come back in. It's exactly the same as the opposite, isn't it? People will start chasing the prices. Then liquidity will come back in the market, and it'll rally. I don't know when that's going to happen, but I think, judging by the states, I don't know if you saw yesterday, but Russia made very few gains at all overnight. They think they've stalled, and they said the weapons now being supplied to the Ukrainians are having a massive effect, taking down planes, taking out tanks. And so it comes to the stage where I know Putin can deny it because he's a liar and a deluded idiot. But I mean, it'll have to come to the point where he'll have to claim some kind of win for his own people or the state TV and in those talks somewhere. But I think he's in a no-win situation here. I mean, he's just I heard a phrase called the rubblization of Ukraine. That's what he's attempting to do, because he can't achieve military success. He's just trying to ruin the whole city. And so I think sooner or later, both sides want to strike a deal, and
that's what the market's already saying. I mean, I would say big picture when it comes to sort of investing, etc. There's two things. One, when the market does go down and we're in a bear market, which we probably still are in to a certain extent, then don't put yourself to become a distressed seller. We have to basically sell to cover positions. I mean, that's just nuts. You've got to be able to wait through it. And likewise, in a bear market, you probably don't want to try and knock the ball out the park all the time with your stock selections, which is what I've tried to do with FD Technologies and SAP and Infineon, i.e. go further up the quality curve into larger caps, safer areas, less volatile, that are going to go through any short-term problems, in fact, medium-term problems, because they're so ingrained in society and into corporates, etc. So, investing is all about sort of like, offense and defense and getting your portfolio construction right at the correct time. So, if you think you're going to go into high alpha generating, but equally high beta, companies, which tends to be small or micro caps with single products, single customers, and all that kind of stuff, and you've got a portfolio, then you've got to be really, really, really thick-skinned to be able to take it, or have a very large, wide, diverse portfolio. And I want a combination whereby I do have a bit of sort of short, small cap stuff, but equally I want some bigger caps as well to give that balance, that reassurance, and just allows you to sleep at night. You can just enjoy a weekend rather than getting stressed out when everything goes down by 50%.
Yeah. No, well, listen, mine is all micro caps, and it's been a tough time, But and I said the markets are very emotional, but the less emotional you are about them, then the better you are, And so you're right. If you need to diversify because you're worrying, do it. Or if you, but I said yesterday on the webinar, I said if you were selling a company, because the share price goes down, but the business underlying is improving and the results are showing that.
You're mad.
Then you're acting with emotions. You're not acting with your brain, and so sometimes you've got to think about that. And again, likewise, if you're just buying a stock because it's going up and people are talking about ramping it on Twitter, again, that's just emotions. It's fear, greed, or anger is not the way to act. You've got to sort of distance yourself a little bit, and if you need, more diversification, if you're worrying over one or two stocks, you're overexposed.
But everybody, but the natural view is, let's be clear about it, we're not robots and we're not AI.
No. I mean,
because that's our advantage. We have that intuition. Exactly. And if you've got a portfolio of only sort of 10 to 15 stocks, which is what I have, etc., everyone's a significant position. And on that basis, when something gets totally clobbered, yes, it's going to be on your mind. And so you don't want all 10 and all 15 to be clobbered at the same time, which is why you do need, a mix there to be able. It all depends on how high octane your portfolio wants to be and how much beta it's got in there. Remember, alpha and beta go hand in hand. Companies that have got the potential to generate huge returns, i.e. 2, 3, 4, even your 10 baggers, which I know you like talking about, if they've got that potential, equally, they've probably got a lot of beta in there, a lot of market risk as well. And therefore, regardless of what the company's doing, it's going to be moving with the market up and down. And you've got to be able to live through that, have long-term time horizons. And that takes a certain set strength, resilience, and, basically just long-term time horizons.
Yeah, no, exactly. That's one of the things I look at. I think it's an awful market at the moment, but the company I'm holding, for example, I look at it in a 3-year time horizon, thinking this company will be so much bigger. They've got plans, their roadmap is there, and it's going to plan, and it's all about risk and reward. It's your appetite for risk, in a sensible way. If you want, outsized returns, it's, big rewards, big risks. It's very volatile.
Yeah, big volatility. You're in the Cathy Wood Innovation Fund sort of.
I wouldn't buy something 100 times revenue, 100 times sales. It's like she's nuts. She's
prepared to wait for her sort of secular growth drivers.
I just think I know she's still outperformed them. I think pretty much. I think it's just maybe not. I think she's just.
Not this year and last year, but certainly over a long period. Yeah, she's done well.
That kind of volatility will go up. It'll accelerate faster down, accelerate faster up as well. So absolutely. Marvellous. Anything else, Paulie?
Well, just finally, the other one I own, which has come out with news, is Purplebricks, which again, as the chart has just been one way and ain't been up, it's been down. But they removed the CEO, and so they've got a new CEO in there now. Vic Darby left. And what's interesting is that the chairman and his partner have been buying, and some big hedge funds have also been buying at some big volume, around about your 15, 18p, which says to me, actually, they can see this thing turning. And I've been early on it, but I can see it as well. I think, with such high house prices, more and more people, more instructions will come onto the market. And, I could see this moving well over the next 12 months, but I've been wrong on it before so far. But, things like Boohoo and Purplebricks, where I'm sitting on big losses, I haven't got to sell, and I'm happy, basically to just keep it going.
Wasn't Purplebricks, wasn't that a bit of who gave you a heads up on that? Wasn't it your daughter's boyfriend?
Yeah, I know. Yeah.
Are you still
Yeah.
friends with him? Get rid of him.
Yeah, no, he's a good guy. Yeah, no, he's a great guy.
Okay.
Let's be clear about it. I made the decision myself, so
No, that's,
you know,
that's
you've got to take ownership.
No,
You've got to
that is
take
it.
ownership.
Yeah. Do you know what? That is one of the traits of a good investor. If you don't take ownership of something, you'll never be wrong. If you're never wrong, you never learn. People who often pick stocks and say, "Oh, that I just copied that of him. It's his fault." You're never going to learn. I don't have the access to your, stockbroking account. I didn't press the buy button. You did. Take responsibility, and you'll learn from it. If you make a mistake, we all make mistakes, but you can't learn it if it's not your mistake. If you push it off onto somebody else, I know, absolutely. Marvelous, cool. Anything else, fella?
Well, we've got a massive few weeks coming up with results, out of the small caps and stuff like that. So, it's going to be huge. Looking forward to it. I've got plenty of companies to catch up with.
Yeah, and the end of the war. That's going to happen as well.
We all hope so anyway.
Yeah.
Have a great weekend.
You too.